following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And if it's Saturday, we're talking about money. August 13th, 1979. 40 years ago, August 13th, 1979, Business Week, maybe the top publication in business at that time, read as much as The Economist is read today, with the astute understanding of what was going on in business. Business Week at that time, on that day, August 13th, 1979, announced with a cover story, "The Death of Equities, How Inflation is Destroying the Stock Market." Inflation had been rising since 1961, and by 1979 was well into the double digits, and it had been there for a few years. The market, which had reached 1,000 in 1966, had gone down 20%, rallied back to 1,000, then went down 30%, then rallied back to 1,000, then went down 40%, rallied back to 1,000, and then was down to another 20% to 790 when that article came out in August of 1979. For 13 years, the Dow had not been able to pass 1,000. Every time it got close, it would come tumbling back down, and it seemed hopeless. Even when the stocks go to 1,000, really, it was just when you discount for inflation, half of the purchasing power had disappeared by the time the stock market got to 1,000. So instead of being 1,000, it was really 500 when you discounted it for inflation. And so Business Week came out with the article saying, "The stock market is dead. The death of equities. How inflation is destroying the stock market." And I've been saying for a number of years now that I expect this secular bull market to end with another bout of high inflation. You know, I believe there's an 85% chance that's going to happen. That means there's a 15% chance or so it won't. And those are my guesstimates. Those are my estimates. It could be off. Who knows? I believe, however, that there's much greater evidence that that's how this is going to end rather than another great recession. But in 1979, it was at the end of that high inflation time period because inflation would start to come down, interest rates would start coming down, and the stock market would begin to rally. By 1979, essentially inflation was over and the stock market, its correction was over. Now that all was happening before I became a stockbroker, before I became a financial advisor. But even during that time, even before I became a stockbroker, I was buying and selling stocks, buying and holding on. And I can tell you, during that period of time, there were stocks that went up. It was not the death of all equities. And even though Business Week was saying it was the end of the equity market, the end of the stock market, there were still stocks that were doing well, that were making a lot of money, and that were increasing. And yes, they had their setbacks, and yes, they went up and down. But if you looked at it from the beginning to the end, those stocks were doing well. So the whole point of that is there weren't index funds at that time, but had there been index funds at the time, the index funds would have reflected the stock market. They would have gone down 20%, back to average, back to down 30%, back to the top, down 40%, back to the top, down 20%. So index funds are not where it is. And I believe we're entering a time with all this volatility where index funds are going to suffer as well. We've been seeing that in the last couple of years. The best thing to do during these times is to have a margin of safety. And what I mean by that is that you have to have enough money that you can live through the volatilities. It's not enough just to live as we are today. You need a margin of safety. I just sent out an e-letter this week saying that we are in a war. And we are. It's not going to be easy to win. It's probably a lose-lose situation. But there will be opportunities. There will be things to invest in, which will keep us going and keep things going. But to put it in a perspective, with all that's going on with the trade war, with the worldwide economy, I think you have to remember the supercycle. I've been talking about the supercycle now for almost 10 years. And I really believe from a mile-high view, you have to focus on what's going on. You know, there's an old saying that when you're up to your belly button in alligators, it's hard to remember your focus is to clear the swamp. That's your job, is to clear the swamp. But when you're up to your belly button in alligators, it's hard to remember that. So it is when we're going through this kind of volatility where the market is down 800 and then it's up 300 and then it's down 700 and then it's up 100. When we're talking about that kind of volatility, it's hard to remember that the idea is to look at the long term, to look at the very long term. And that's where we are. So every 3 months to 6 months, I talk about the supercycle, and I'm going to continue to do that until it's not really valid anymore. Supercycle, it was a study that came out of Standard Chartered Bank out of the UK, large bank in the UK, 37,000 employees, 17,000 branches, something like that. Their study showed that there are periods of time, long periods of time, when worldwide GDP growth averages more than, significantly more than average. The first cycle, as you recall, if you've been listening to the program, should know this by memory, you probably can tell it better than I can, that from 1870 to 1913, a period of 43 years, world GDP grew faster than average. And it was driven by the industrialization of the United States. Even though we were going through financial crises during that period of time, we were moving from an agricultural nation to an industrial nation. There was a lot of pain going on in the U.S. 50% of the people were employed on the farms when that all began. By the time it ended, a whole lot fewer were employed on the farms, and we had seen a migration into the cities and a migration to industrialization. But that was not just in the U.S., that was happening worldwide, and it was driving worldwide growth, because not only were we doing industrialization, but we were buying things and shipping things to other countries. We were to truly change. London was the financial center, and we were beginning to emerge as the financial center. The second cycle came from 1945 to 1970. It was a period of 35 years, and it was driven primarily by the reconstruction of Europe, by Asian exports, by the decolonization of a lot of the European nations. Relatively benign in business cycles. There was a lot of growth in wealthy countries like the U.S. and the U.K. and France and Germany. And the stock market went from 150 to over 1,000. It was the death of the colonial system in Africa and Asia. It was the beginning of the Cold War as well. But that was the second period of time in which we saw GDP worldwide grow faster than average. And then the new cycle, which Standard Chartered Bank said started in 2009, they expect it to go for past 2030. Will it go past 2030 or not? Who knows? But it's driven primarily by emerging nations. The winners are going to be global winners. When you look at it, many of those countries are in Asia. We're already seeing a lot of that happen. China and India, Indonesia, Malaysia. But we're going to see it in Brazil and Russia and Turkey and sub-Saharan Africa. The BRIC investment thing is probably not valid, but those are countries where we're going to see bigger than average growth. Also going to be a lot of risk, political and social volatility. We're seeing that happen as we move along, and we've seen that over the last 10 years. The Arab storm was one of those examples. Countries are going to be less transparent, they're going to be less stable, and investment's going to be more vulnerable. The fundamentals will shift the balance of power. And it's not going to be just in industries, but it's going to be companies as well. But the economic momentum is upward. I had a client once who was the plant manager for American Standard, 1,000 employees in China. Those employees were making toilets and bathtubs and shower stalls. Not one of those 1,000 employees had ever seen a toilet, had never seen a bathtub, had never seen a shower stall, and that's what they were producing. Today, those people have smartphones, they have TVs, they drive cars. It's been a complete change, and that's just one small example. That's happening worldwide. And those people, instead of living at subsistence levels by raising their own food, sewing their own clothes, they're consumers. They're buying lattes. They're buying store-made clothes and no longer their own. They're buying groceries at the store. That's happening worldwide, and it's driving worldwide growth. We're coming to a commercial break. Don't go away. You've also got to hear my guest. He was on a couple years ago. We're going to update what's going on in his world. And you also want to hear the rest of the story because there's so much going on in volatility in the market. And I'll address some of that when we come back too. Don't go away. Stay with me through this whole period of time. We're coming up to a commercial break right now.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, during the first part of this program, I've been talking about the mile-high view, the long-term view. It's something to keep your eyes on. As I said before, and I like the saying that when you're up to your belly button in alligators, you forget that the job is to clear the swamp. I believe that's happening now with the jitters and with what's going on and the volatility in the market. I believe you have to maintain that long-term approach to be able to do as well or better than the market. But the stock markets are jittery, and the most recent thing now is the inverted yield curve. This is a program. I'm just repeating what I said in November 2017. That's what comes around goes around or something. I don't know. November 2017, all of a sudden, everybody was talking about the bond vigilantes. Who are the bond vigilantes? There's a little more talk about bond vigilantes today in the inverted yield curve, predicting a recession. And so people are fleeing from the stock market and going to buy bonds. Well, the bond vigilantes are not an organized group. When I got into the business in 1986, soon after I passed through the rookie time, I sat next to two bond brokers. Both had been in the business selling bonds to clients and buying and selling bonds for about 30 years. So they've been around a long time. They'd gone through the high inflationary time, and they knew what to do with bond portfolios during those times. But they were part of a group of bond brokers all around the U.S. who traded only bonds. They didn't do much in stocks. They just did bonds, and they knew the bonds inside and out. The first thing they said to me is, you have to learn about bonds. You have to read the Municipal Bond Handbook by Fabrozzi. It's a 2-volume thing, 1,700 pages. The first 100 pages talk about the things we normally know, about the coupon, about the return on the bonds. And there's 3 parts to the return. There's the interest rate, the coupon, the reinvestment of that interest, and the third thing was capital appreciation. Now, the first 200 pages or so talked about the coupon and gave definitions about all this stuff. But about 1,600 pages is devoted to how you get capital appreciation out of bonds. And the reality is about 1/3 of the total return comes from the coupon, which most people focus on. 1/3 comes from the reinvestment of that coupon, but 1/3 comes from capital appreciation. And these guys were really good at looking at all three aspects of that. They knew the coupon, they knew the credit rating, they knew the call dates, the maturity dates, they knew how all that worked. They also knew that you didn't build the bond ladder, because a bond ladder is a very lazy way to put together a bond portfolio. It's lazy and it's for a novice. That was what they said. These are people that don't know what they're doing. And they've got clients who want bonds, so they put them in a bond ladder and they don't have to worry about it. They're novices. They're not very experienced. That's what I've been trained to do, was to do bond ladders. They said, don't do it. This is what you need to learn. This is how you need to do it. Those were the bond vigilantes. Not only were they aware of what was going on in the bond market, they were very aware of how the bond market affected the stock market and how the stock market affected the bond market. So they paid attention to what was going on. They paid attention to the Dow. They paid attention to the Standard & Poor's 500. They paid attention to where things were in the economy as well. They looked at credit and debt, and they looked at all those things that went into it. And they knew that when rates were decreasing, there was a lot of capital appreciation to make. When rates were increasing, you had to really work at doing kicker bonds. You had to really work at doing things to get capital appreciation. But we talked about the yield curve flattening because it did flatten. And it reminded me of what Paul Samuelson wrote in his economics textbook. Back in the 60s and 70s and 80s, the number one economics textbook for Economics 101 was the textbook by Paul Samuelson. And in the 5th or 6th or 9th chapter, I don't remember where, he said that the stock market correctly predicted 9 of the last 5 recessions. Think about it. Predicted 9 of the last 5 recessions. And so it is with the inverted yield curve. I'm sure that the inverted yield curve predicts 9 of the next 5 recessions. It's just because the curve inverts does not necessarily mean we're going to have a recession. And we are inverted, not completely inverted. If you look at the 1-month T-bill, it's paying about 2%. If you look at the 10-year bond, it's paying about 1.5%. Normally, you'd expect the 10-year to be paying more than the 1 month by a considerable margin. The 30-year is paying about 2%. So you get this curve. You can see that it starts up, it goes down to the 10-year, and then it starts back up again. That's not really an inverted yield curve for the first thing. A really inverted yield curve is like the Australian curve in 1986 or 1987, when short-term rates were 13%, 10-year rates were 5%, and 30-year rates were 3%. That is truly an inverted yield curve. And what that means is the economy is really headed for a slowdown, and people are worried about a slowdown. But with a curve like that, there's also some validity to the fact of concerns about what's going on. And in our case, what's going on right now, there's concern about monetary policy, whether the Fed's going to tighten rates, and they were tightening rates, whether they're going to loosen rates. And that's not only in the U.S., it's worldwide. Right up until the most recent past, we've had central banks tightening credit by raising their Fed funds or equivalent Fed fund rate. That has reversed itself. How is it going to come down? How is the government going to treat fiscal policy? We went through the tax cut, but then how does the Treasury go forward on fiscal policy? How does the Fed go forward on fiscal policy? What does the European Central Bank do for fiscal policy? We're seeing the Chinese play with fiscal policy with manipulating their currency. Other countries are doing the same. We've also seen the fact that in 5 countries are coming very close to a recession, including Germany and the UK and Japan. Brazil is already in a recession. So you're starting to see from a world that for coming out of the Great Recession, every single country, with the exception of Venezuela, had a positive GDP growth. Now we're starting to see things flake off. And of course, China, the trade dispute, and the trade war. So all of that could very well be slowing down growth, but it doesn't mean we're going to turn negative. In short term, when things turn slower, you have a tendency for institutional investors to buy bonds, short-term bonds, 10-year bonds, short-term bonds, even sometimes 30-year bonds. All those are valid concerns, but it doesn't mean that it is a precursor to a recession. All that. The bond vigilantes are out. They're concerned. They're looking at bond rates. They've been expecting bond rates to go the other way, to rise and not fall. They're looking at it as the reason that rates are coming down must be that we're headed for a recession. But for the ones that have been around a long time, I think they know that it's not necessarily a recession. We have an inverted yield curve, or similar to an inverted yield curve. We have a lot of concerns going on, and we have a trade war with China going on. We have aspects in Europe and China that are certainly concerning. All that's going on. We went through a lot of this in the 1982 to 2000 time period as well. And we came out of that just fine. We had a recession in 1991, 92. And still, the stock market went from 1,000 in 1982 to 10,000 in 2000. So hang in, keep the long-term view, and we'll come back and talk about some other things. But right now, I want to shift. I want to introduce my guest today, Anthony Mashmet. Did I say it correctly?
Yeah, close enough.
Okay. Of Dwell Housing. Welcome to the
Dwell
program.
Development, actually.
Okay.
Sorry.
I screw up everything.
It's okay.
Okay. So welcome to the program.
Yeah, thank you for having me back. I appreciate that.
So give us a quick background on yourself.
So Dwell Development was founded in 2005, and our focus is on modern, sustainable, high-performance homes in the city of Seattle. And we've won numerous national and international awards for our product. Net zero energy is our focus. Passive house is our focus, but really quality homes that are healthy to live in and are comfortable for Seattle residents.
So we're going to talk about that. We're coming to a commercial break.
Yeah.
But that's the teaser. So you've got to stick around, listeners, to hear about this. I mean, we talked about it 2 years ago.
Yeah.
A number of people called. If you're listening to this program, you should call as well. If you're thinking about a house, even repairing a house or modifying a house, upgrading a house. We'll talk about that too. We're coming to a commercial break. If you missed this program, if you've missed some of the previous programs, you'll find them on YouTube. You'll also, if you let us know by contacting Adams Financial Concepts, we'll put you on our e-letter list. I sent out an e-letter. The last one I sent out was, we are at war. I've sent out returns. I've sent out a number of things. How is this market going to end? So if you're listening, go ahead and sign up for the e-letter list. Like us on Facebook. Follow us on Twitter. And we'll be right back after this commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Anthony of Dwell Development.
Yes.
We're talking about the homes that he's building. So let's get into that and give us the same brief overview that you gave, and then we'll get into some more detail.
So what we do at Dwell is a little bit different. We're more of a boutique design build firm where we're focused on design and sustainability in the speculative market. So we design and build homes and we put them on the market and hope people buy them and appreciate all the positive things we do when we put into those homes, such as solar panels and heat recovery ventilators and high performance windows and no toxins or formaldehyde. So, we put our product out there and the market responds to it quite well. And that's what we're focused on.
So talk to us about the grades. People talk about building green, but building green can be just a 10% savings of energy. It doesn't have to be all the way in. Talk to us about the grades, first of all.
Well, let's start with the word code. Everyone says, oh, my home was built to code, right? So that is like the worst house you can legally build and get away with it. It's like getting a D-. That's how I used to say it. So congratulations, you have a D- for that home that you just built, which is the bare minimum, which is the minimum that the city will allow you to build. So our focus is in a program called Built Green, which is rated on a star system, a 3-star, 4-star, 5-star, and then beyond that with net zero. So we're the only builder in the city of Seattle that does exclusively 5-star Built Green, which our homes are built about 50% above energy code before you add the renewable energy, such as solar panels on top of them. We also do net zero energy homes, quite a few of them historically. We've done about a dozen of those historically, and a few passive homes, which are homes that are already achieving net zero energy consumption on an annual basis, or actually giving you back money every year on utilities. So we focus on giving home buyers a base of a 5-star, and we can put the solar panels on, or our home buyers can put them on at their own choosing at a different time.
So talk about what's a 3-star, 4-star, and 5-star.
Yeah, so a 3-star home is, we just came out with a white paper. I'm the chair of the Built Green Executive Committee here in the city of Seattle, which is part of the Master Builders Association of Kingston and Snohomish County. It's the largest building association in the country by far. It's huge. So Built Green is a part of the Master Builders Association, and there's a rating system that Built Green has created, a checklist. So a 3-star home is a home that's built around 20 to 25% above energy code, which is good. 4-star, all right, which is a home about 35%, sometimes 40%, depending on the components of that home. And then a 5-star Built Green home is around 50% or more. So it's a star-rated system, and that's about a good average depending on the components that a builder puts into it.
So tell us about the components. How do you get it to energy efficiency?
That's the secret sauce, right?
Yeah.
So how do we get there? So we use the German methodology of a passive house. And the concept behind a passive house is to build a house super airtight with high performance windows that don't let all that heat leak out of those windows, that keep the solar gain inside, massive amounts of insulation, and then you have to ventilate it. So the saying is, you build it tight, you must ventilate it right, really plays true in a passive house, because if you don't ventilate a home, it will rot, it will disintegrate because there's no ventilation in the home, it will go stale. So we focus on that. We call our homes powered by passive house, but we don't want to take it to that level because it's super airtight, could be not necessarily a good thing if it's not ventilated properly. So the components that we use is an airtight exterior, like a big blanket wrapped around the house, airtight, waterproof, with massive amounts of insulation, high performance windows, triple pane windows or passive house certified windows, and then we add a thing called the heat recovery ventilator. So that's the thing that's moving the air around the house on a regular basis. It's pulling out all that warm, stale air, dumping it outside, and instead of just bringing in cold air, there's a heat exchange process that happens. So if it's 0 degrees outside and you want your house at 70 degrees, that air is coming in at about 68 degrees preheated. So then your thermostat doesn't kick on, your heat doesn't kick on, and you have fresh air constantly. So that's the backbone of it. And then we layer a lot of other things inside the house, from renewable recycled materials and reclaimed materials, and no formaldehyde or added urea in any of our products. So, it's a whole wellness-based system: water, site, utilities, everything all into one.
So talk about reclaimed materials.
That's the fun part. My wife, Abby, is our designer and my business partner, and she's the queen of finding reclaimed. She has guys that live out in the woods in Montana that have mills that take down old bars and, and old barns all over the place. And she's like on a call list because she's always grabbing and procuring old product that we can use for siding or we can use for flooring. And, 100-year-old beautiful wood that would normally go into a landfill somewhere, we're reusing and repurposing it in our homes. And it kind of makes a unique architectural statement, but it's also the right thing to do and not just throwing those things away and reusing them. And there's stories. So those materials live on as opposed to going out the pasture. So it's fun.
And what about lighting?
Lighting, for us, it's all LED, right? I mean, where lighting has come in the last 10 years is unbelievable, Incandescent light bulbs are illegal in Germany, and they should be illegal here.
They should.
We have LED, and all our homes are all LED. There's no reason why you wouldn't have LED light bulbs. They have beautiful Edison-style bulbs that you can put in old fixtures to make them look neat and architectural. But they're cost-effective, and you never have to change. So you take LED light bulbs, you take WaterSense certified plumbing fixtures like shower heads and faucets that reduce water down in your home by 30 to 40%, low flow water toilets that reduce water by about 5,000 to 7,000 gallons a year just by having one of those toilets in your house. All those things start adding up. They add up for to decrease your utility bills, and then they add comfort to your home.
And I think it's something that's really worthwhile for the environment.
Oh, yeah, absolutely.
When you care about this earth,
yeah,
that's something that really makes sense.
Oh, yeah. And the reduction of the carbon footprint of one of our homes is substantial compared to a co-built home. So you take all these things and you put a nice bow around it with a nice architectural element to it, like we feel we do. We take a lot of time to design a beautiful home. But behind the walls is where all the secrets are kind of held. So, we interview our buyers, and we want to make sure that they are qualified and appreciate the types of homes that we build. And a lot of people look at me like, that's kind of arrogant of you. You're a builder. You're supposed to sell these homes and, for as much money as you can. It's like, for us, it's not necessarily about, selling these homes for as much money as we can. We want to sell them to the right people who will then advocate for us and support us out there and saying, we buying these homes for the right reason because they're very special and they're important, and every home should be built that way. And we hope to lead the charge to train and teach other builders, hey, call me up. I'll share with you everything I know about building sustainable homes because we believe every home should be built this way.
What about restoration homes or homes that people are buying? Or, there was a time in which you bought a small home when you got married, and then you had children, you got a bigger home. Yeah. Today we're seeing a lot of that change. We're seeing people, instead of moving up in homes, remodeling their homes or reconstructing their homes.
Or preserving beautiful old homes in the city of Seattle. And, it's funny you brought that up because we hit a snag here in our building cycle that was contributed by, unfortunately, the city of Seattle changed their permitting system to an electronic system that's bogged down all the permits for the last year and a half. So we had a big hole. So we're sitting here and we're like, well, what do we got to do? We have like 10 projects that are waiting. We're supposed to be building homes. So we actually bought 3 historical 1,800 and 1,900 homes, year-built homes in the Central District. Instead of those homes being torn down, we are restoring them back to their glory days. Beautiful Victorian, built in 1890, another one built in 1905. And so getting in and learning the tricks about how to get an old home to be new with new windows and insulation and wiring and plumbing, and bringing that old architectural element but with all of the creature comforts of a sustainable home has been a really fun challenge and very exciting, and it saved these homes from going to the wrecking ball as well. So we do see a lot of people that want to remodel and stay in their homes, especially with the housing prices in the city of Seattle right now, and then they continue to go up, even though we've kind of hit a plateau here the last year or so. Things have stabilized a little bit. But I do think for the right people, it's the right move because, staying put, it could be a lot more cost effective and better for keeping your equity in your home, for sure.
And if you can make it environmentally friendly as well.
Absolutely.
Green,
yeah.
And add, not just solar panels, because a lot of people think about solar panels. But what you're describing goes far beyond just solar panels.
Oh, far beyond. And I just wrote an article for the Seattle Times, which will be in this weekend, 5 tips to make your home more sustainable. So if you want to check out the Seattle Times, the weekend edition, there's 5 tips from Anthony at Dwell Development, talking about those same things. But it's all about, insulation, windows, Energy Star appliances, high performance toilets. And so you take all those things that every homeowner can do a lot of those things themselves over a period of time. You don't have to do them day one, but you can change out your light fixtures, and then next year you can change out your plumbing fixtures. And those are things that you can do that aren't really hard or really expensive.
So tell people who are listening Tell people how they could get a hold of you.
Okay. Well, we have a great website, and I always encourage people to go because it shows all our homes. It shows the awards that we win, the stories that are written about us, the pictures of our home, who our team is, and really what our mission is. Great videos on there, and that's at dwelldevelopment.com. Pretty straightforward.
And Dwell is just like it sounds. DWELL.
At dwelldevelopment.com, all one word. Yes.
And so what's the process? If somebody calls, what's the next step?
Well, typically we don't work with custom clients. I go find land. I find dirt that is appropriate to place one of our homes, and we design it. We entitle that piece of dirt, get the permits on it, and then we build it ourselves. And then we turn around and we put it on the market and hope people appreciate it as much as we do. And the market has shown that. I mean, during that last downturn, right before I was here last, I mean, my company grew 300% during the downturn because of our mission for sustainability and because of our design direction. People were buying our homes and framing when nobody else was even building homes. So we ramped up and we took advantage of that market.
But you wouldn't turn down somebody that wanted to build a custom home, huh?
I have that. It's a different business model.
Okay.
For the right person, I'd definitely do it, but it'd have to be a real synergistic kind of relationship for us to take that on. It's just different.
Different.
Yeah.
Okay.
Yeah.
But thanks for being on the show.
Oh, thanks for having me back, and then let me share what we're doing as well.
That is fascinating.
Yeah.
And it is leading a new industry.
It is.
So don't go away. Come back. We'll talk about some of the things that are going on in the financial services business.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Okay, so remember a couple years ago, Wells Fargo was in the news. 5,300 employees felt so much pressure to meet sales goals that they opened fictitious accounts. It was a culture of you have to perform. And they had to open extra accounts. They had to open checking accounts. They had to open auto loan accounts. What was going on there? The fact is they had a slogan called 8 is great. So if you had one Wells Fargo account, whether it was checking or whether it was a credit card or whether it was an auto loan, they wanted the person who was working with that to get you to do 7 more products. A checking account, if you had a checking account, home mortgage, an auto loan, credit cards, retirement planning, financial planning, a trust account, annuities, insurance, business banking, equipment financing, commercial real estate, student loans, boat loans. 8 is great. That was their focus, and they pushed people into opening fictitious wrong accounts. 5,300 employees were fired, and eventually some of the top management were gone. Notice, all those things were done in the interest of the bank, not in the best interest of the customers. It was in the interest to see the bank grow. And notice what those products were. Well, the question is, are we seeing that again with another bank? So when you look at the financial services industry, almost every one of the financial advisors has the same tools and the same technology, financial planning programs. You just plug it into a computer. You can buy different types of financial planning programs, but they're essentially the same. And you end up with a financial plan. Now, since Anthony was just here talking about Dwell, I thought there might be an analogy to a financial plan of how it performs during difficult times. Somebody comes to Anthony, they want him to build a 3-bedroom home. They give a plan, they put the plan into effect, they pour the foundation, and then the person says, well, maybe instead of 3,000 square feet, I want 4,500. And I want to do 6 bedrooms. So you make some changes in the foundation, you start to put it up, and they come back and they say, well, you know what? I'd rather have 2 bedrooms and not quite so large. That's what happens. And it's maybe a bad analogy, but that's kind of what happens with financial plans. Everything as long as everything's going along smoothly and the economy's doing well or not dipping into too much of a recession, you have your 3-bedroom house, which is just going fine, and the foundation is there. But when you have a great recession or a high inflation period of time, that's like changing your mind on wanting 6 bedrooms or 2 bedrooms. That's the financial plan. They don't really address major changes. Probably not the best analogy, but it seemed appropriate since Anthony was here. When I came into the brokerage business, the big firms had 93% of the market share. Registered investment advisors had about 7%. Well, that was in the mid-'80s. So what's happened over the last 30-some years is that the RIA, the Registered Investment Advisor segment of the market, now has a greater market share than the major brokerage firms. That happened this last year. The RIAs have surpassed the big brokerage firms. And in 2017, RIA firms were growing, whereas the big brokerage firms were losing money, or at least going down in terms of the assets. So the newest thing that happened 2 years ago, and Merrill Lynch kind of leads the market and leads the way in a lot of things at the big brokerage firms. Merrill Lynch changed their payout grid for their financial advisors. And they wanted to have a focus on growing new accounts. Because remember, they're losing market share. Their revenues are going up some. They're seeing that their costs are actually rising faster than their revenues. So they came out with a program to reward advisors for bringing in new accounts. And how did that work? Last year, Merrill Lynch opened 35,000 new household accounts. Well, with 14,600 financial advisors, that's about 2.5 households per financial advisor. I expect to open probably 8 accounts this year, but then that's me. But the impact on Merrill has meant that their net loss of financial advisors, they lost 189 more than came in. If you compare that to a year ago, they had a net loss of 20. And it's not confined to Merrill. It's UBS lost 248 net loss. Wells Fargo in 2018 lost 576. And where they're going? Most of them are going to registered investment advisors and smaller brokerage firms. But coming back to Bank of America and Merrill Lynch, because Bank of America owns Merrill Lynch, what they're also doing is they're forcing those brokers, those financial advisors, they're forcing them to cross-sell products. And when cross-selling, what that means is it's back to the Wells Fargo. 8 is great. You know, the Merrill Lynch broker also has access to checking accounts and home mortgages and auto loans and credit cards. They have access to annuities and business banking and equipment financing and commercial real estate and student loans and boat loans. Bank of America wants their financial advisors to cross-sell into those other things. It's not a question, what's in the best interest of the client? You know, does the client really need a business banking or equipment financing? And if they do they really need it at Merrill Lynch? The question is not whether it's in the best interest of the client. It's in the question, is it in the best interest of Bank of America? And what's happening in the financial services world is that 60% of the financial services firms, the big firms, are seeing their revenues grow, they're seeing their assets grow, but they're seeing their costs grow faster than revenues. And when costs grow faster than revenues, what does that mean? That means profits are getting squeezed. So what do? You can either cut cost or you can increase your revenues faster than cost. So what we're seeing is both. TD Ameritrade just recently sold their unbundled 401k business. What's that mean? So TD Ameritrade, when you have a 401k, you have several parties to it. You have the advisor, you have a third-party administrator, you have a record keeper, and you have the custodian. If you bundle all those services together, you never know how much you're paying for all those services, and a lot of the costs can be hidden. So TD Ameritrade got rid of their unbundled, where people had separate third-party administrators and separate record keepers. And believe me, that's where we are. We are an unbundled firm. We don't do that. We try to find the very best record keeper, the very best third-party administrator. We think we're the best advisor. And then we have a custodian. Well, TD Ameritrade thinks they make more money when they hide everything all together. So they did that. JP Morgan, BlackRock, State Street, and other lesser well-known firms have all cut staff. They're cutting their cost. Fees are getting squeezed. And what it boils down to is it's not about performance for the client. It's about cutting costs and increasing revenues at the expense of the clients. You know, there's an old saying in the airline business. How do you make $1 million? Start with $2 million. You know, I think that's a great advice. How do you survive a great recession if you really want to have $1 million at the end? You should go in with $2 million. You do better. That's what performance is. Having more money than you need so that you can go through the downturns and still have plenty of money at the end. Anyway, that wraps up today. I'll be back next Saturday with another show about money.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.